My name is Hafizah and my ID number is PDA 1805028 and I'm from the IA6B.
Hello, my name is Danish, binti. My ID number is PDA 1805035.
Hi, I'm Auni binti. My ID number PDA 1805027.
Accounting policies known as specific principle, basis, convention, rules and practice adopted by the enterprise in preparing and presenting financial statements. For examples, companies can value inventory using the average cost, first in, first out or last in, first out method of accounting. Under the average cost method, when a company sells a product, the weighted average cost of all inventory produced or acquired in the accounting periods is used to determine the cost of goods sold. So for the Box Park Malaysia Berhad and Bright Packaging Industry Berhad, we compared for their property, plant and equipment in Box Park Malaysia Berhad. All items of property, plant and equipment are initially recorded at cost. After initial recognition, property, plant and equipment are stayed at cost less any accumulated depreciation and any accumulated impairment losses. Depreciation is calculated to write off the cost of the assets to their residual values on a straight line basis over their estimated useful life. But for the Bright Packaging Industry Berhad, there is no depreciation provided on freehold land. Depreciation on other property, plant and other equipment is calculated to write off the cost of the assets to its residual value on a straight line basis at the following annual rates based on their estimated useful life. Next, for the inventories, Box Park Malaysia Berhad recorded their inventory at cost of raw materials, work in progress and finished goods are determined on first in, first out basis, which is FIFO method. Meanwhile, for the Bright Packaging Industry Berhad, the cost of inventories is determined on a weighted average basis. Net realizable value represents the estimated selling price less all estimated costs to completion and costs to be incurred in selling and distribution. The last one is leases. Box Park Malaysia Berhad entered into non-cancelable operating lease agreements for the rental of hostel and equipment. These leases have an average of 2 years with options to renew. For Bright Packaging Industry Berhad, total lease commitment and the fair value of the assets acquired are recognized in profit or loss over the term of the relevant lease periods to give a constant periodic rate of charge on the remaining balance of the obligation for each reporting period. All other leases which do not meet such criteria are classified as operating lease and recognized as an expenses on a straight line basis over the terms of the relevant lease.
Accounting basis refers to the method according to which revenue and expenses are recognized in a company's financial statements. The according justification to be used is usually listed as a reference in the notes that a company releases as part of its financial statements to the other parties which is outside of the company. Under the accrual basis of accounting, transactions and events are recognized when they occur. Under the cash basis of accounting, the company acknowledges revenue when cash is received and expenses were paid. For the Box Park Malaysia Berhad, basis accounting, the financial statement of the group and of the company have been prepared under the historical cost convention except as otherwise stated in the financial statement. Revenue from sale of goods is recognized at a point in time when the products have been transferred to the customers and coincides with the delivery of products and accepted by the customers. The amounts of temporary difference for which no deferred tax assets have been recognized in the statements of financial position. Next, for the Bright Packaging Industry Berhad, the financial statement have been prepared under the historical cost convention and any other basis described in the significant accounting policies as summarized below. Revenue is measured at the amount of consideration to which the group expects to be entitled in exchange of transferring the promised goods or service to the customers, excluding amounts collected on behalf of third parties such as sales tax and service tax. Portion of deferred tax assets have not been recognized as it is not probable that taxable profit will be available in the foreseeable future to utilize these tax benefits.
Accounting estimates determine the carrying amount of some assets and liabilities. It requires estimation of the effects of uncertain future events on those assets and liabilities at the end of the reporting period. These estimates involve assumptions about such items as the risk adjustment to cash flows or discount rates. Future changes in salaries and future changes in price affect other costs. Therefore, apply by company box part measure Berhad, the depreciation, the estimate useful life represent common life expenses applied in the industry within which the group operates. For the leasehold land and buildings, is 1/3% until 1/3%. Plant, machinery and equipment 6/3% until 10%. Furniture, fittings and office equipment 10% until 50%, and motor vehicles 10% until 20%. For bright packaging industry Berhad, depreciation on other property, plant and equipment is calculated to write off the cost of the assets to its residual value on a straight line basis at the following annual rates based on their estimate useful life, which is buildings 2%, plant and machineries 3.75% until 10%, furniture, fittings and office equipment 10%, and motor vehicles 20%. Impairment of non-current assets for box park measure Berhad. Management has determined that the recoverable amounts are in excess of the carrying amounts of the PPE and no impairment has been recorded in the current financial year. For bright packaging industry Berhad, the carrying amount of assets subject to accounting for impairment are reviewed at each reporting date to determine whether there is any indication of impairment. If any such indication exists, the assets recoverable amount is estimated. Industry Berhad, factory building 23 years and office building 27 years.
So, firstly, MFRS 101, presentation of financial statement. The scope is applied in preparing and presenting general financial statement. Applies to all types of enterprise and use terminology that is suitable for an enterprise with profit objective. There's 4 types of measurement in this MFRS, which is going concern, accrual basis of accounting, consistency of presentation, and materiality and aggregation. For the measurement, going concern, management shall assess an entity's ability to continue as a going concern. It also shall prepare financial statement on a going concern basis. When an entity does not prepare financial statement on a going concern basis, it shall disclose the fact that management consider all available information about the future. Next is accrual basis of accounting. Accrual basis of accounting is an enterprise should prepare its financial statement when the accrual basis of accounting is used. An entity recognize items as asset, liabilities, equity, income, and expenses. So, next is consistency of presentation. A significant acquisition or disposal should be presented differently. And the last one is materiality and aggregation. Each material item should be presented separately in the financial statement. Immaterial items should be aggregated with amounts of a similar nature and need not be presented separately. Financial statements, which are structured by being aggregated into groups according to their nature of function. The final stage is the presentation of condensed and classified data. So, what is the purpose in MFRS 101 actually? There are 2 types of purpose, which is to provide information about the financial position, financial performance and cash flow of an entity. Financial statement also show the results of the management stewardship of the resource entrusted to it. To meet this objective, financial statement provide information about the enterprise such as asset, liability, equity, incomes and expenses, including gains and losses, and also cash flow. What is the disclosure in this MFRS? There are lots of disclosure, but I only can comply to you 3 disclosure, which is its significant accounting policies comprising the measurement basis and the other accounting policies. It should inform users of the measurement basis or basis used in the financial statement. When an entity uses more than one measurement basis in the financial statement, it is enough to provide an indication of the categories assets and liability disclosed along with significant accounting policy or other notes the judge point. In the box part Malaysia Berhad, the financial statement in this company is statement of financial position, statement of profit or loss, statement of comprehensive income, consolidated of statement of changes in equity, statement of changes in equity, statement of cash flow, and notes to the financial position. For bright packaging industry, they only provide 5 financial statements, which is statements of comprehensive income, statement of financial position, statement of changes in equity, statement of cash flow, and notes to the financial statements. For the accounting concept in both parts, the financial statement of the group and of the company have been prepared under the historical convention, but in bright packaging industry Berhad, they also use historical cost convention and any other basis. And the lastly is basis consolidation. The consolidated financial statement for the financial year ended 31st December 2018 in Box Park, Malaysia Berhad comprise the company and its subsidiary. Same goes to the bright packaging industry Berhad. The consolidated financial statement comprise the financial statement of the company and its subsidiary as at the reporting date.
So, I will continue to explain more about the standard MFRS 102, which is inventory. I will explain about the scope, measurement, disclosure, recognition, and application by company, which is we choose Box Park holding company and bright packaging company. For the scope of this standard, it is applies to all inventories except financial instruments and biological assets, but this standard does not apply to the measurement of inventories held by producers of agriculture and forest products. Next, for the measurement, it has 4 methods, which is cost of inventories, techniques for the measurement of cost, cost formula, and net realizable value. For the cost of inventories, the cost of inventory shall comprise all costs of purchase, cost of conversion, and other costs incurred in bringing the inventories to their present location and condition. For the cost of purchase, comprise the purchase price, import duties, and other taxes. Trade discounts, rebates, and other similar items are deducted in determining the cost of purchase. Next, cost of conversions include costs directly related to the units of production, such as direct labor. They also include a systematic allocation of fixed and variable production overheads. Fixed production overheads are those indirect costs of production that remain relatively constant regardless of the volume of production, such as depreciation and maintenance of factory buildings. A production process may result in more than one product being produced simultaneously. The second last for cost of inventories is other costs. Other costs included in the cost of inventories only to the extent that they are incurred in bringing the inventories to their present location and condition. An entity may purchase inventories on deferred settlement terms. And the last one for the cost of inventories is cost of agriculture produce harvested from biological assets. In accordance with MFRS 141, agriculture inventories comprising agricultural produce that an entity has harvested from its biological assets are measured on initial recognition at their fair value, less cost to sell at the point of harvest. For the next method is technique for the measurement of cost, such as the standard cost method or the retail method. Technique for the measurement of cost may be used for convenience if the results approximate cost. Standard costs consider normal levels of materials and supplies, labor efficiency and capacity utilization. They are regularly reviewed and, if necessary, revised in the light of current conditions. The retail method is often used in the retail industry for measuring inventories of large numbers. For the next method is cost formula. The cost of inventories of items that are not ordinarily interchangeable and goods or services produced and segregated for specific projects shall be assigned by using specific identification of their individual costs. The cost of inventories other than those dealt with in paragraph 23 shall be assigned by using the first in, first out, which is FIFO or weighted average cost formula. For inventories with a different nature of or use, different cost formula may be justified. And the last method is net realizable value. Net realizable value is the cost of inventories may not be recoverable if those inventories are damaged, if they have become wholly or partially obsolete, or if their selling price have declined. The cost of inventories may also not be recoverable if the estimated cost of completion or the estimated cost to be incurred to make the sale have increased. It is usually written down to net realizable value item by item. In some circumstances, however, it may be appropriate to group similar or related items. For the recognition, when inventories are sold, the carrying amount of those inventories shall be recognized as an expense in the period in which the related revenue is recognized. The amount of any write-down of inventories to net realizable value and all losses of inventories shall be recognized as an expense in the period the write-down or loss occurs. Some inventories may be allocated to other asset accounts. And for the disclosure, the financial statement shall disclose the accounting policies adopted in measuring inventories, include the cost formula used, the total carrying number of inventories and the carrying amount in classification appropriate to the entity, the carrying number of inventories carried at fair value less cost to sell, the amount of any reversal of any write-down that is recognized as a reduction in the number of inventories recognized as expense in the period in accordance with paragraph 34. Information about the carrying amounts held in different classification of inventories and the extent of the changes in these assets is useful to financial statement user. For the application by company, the company we choose is Boxpark Malaysia Berhad and Bread Packaging Industry Berhad. For the cost of inventories, for Boxpark Malaysia, cost of raw materials, work in progress and finished goods are determined on first in, first out basis. While Bread Packaging Industry, the cost of inventories is determined on a weighted average basis. Net realizable value for Boxpark is a reversal of write-down of inventories of the group was made due to increase in net realizable value of certain inventories. While Bread Packaging Industry, net realizable value represent the estimated selling price less all estimated cost to completion and cost to be incurred in selling and distribution. And the work progress used by Boxpark Malaysia is capital work in progress is stated at cost, and spare part consumed out of the groups and the company's property, plant and equipment are classified as upkeep of machinery and the cost of sale. While Bread Packaging, cost of work in progress and finished goods comprise the cost of raw material used, direct labor, other direct costs and appropriate production overhead.
So I will explain about MFRS 116, property, plant and equipment. Okay, for the scope, this standard shall be applied in accounting for property, plant and equipment, except when another standard requires or permits a different accounting treatment. Okay, this standard does not apply to property, plant and equipment classified as held for sale. Second, biological assets related to agricultural activity. Third, the recognition and measurement of exploration and evaluation assets. And the last one is mineral rights and mineral reserve, such as oil, natural gas and similar non-regenerative resource.
Okay, for the measurement and recognition, it shall be measured at its cost. It have two methods of the measurement, which is element of cost and measurement of cost. For element of cost, the cost of an item of PPE comprise its purchase price, include import duties and non-refundable purchase tax. Second, any cost directly attribute to bring the asset to the location and condition necessary for it to be capable of operate. And last one, the initial estimate of the cost of dismantling and removing the item and restoring the site. For the measurement of cost, is the cash price equivalent at the recognition date. Second one, it is measured at fair value unless the exchange transaction lacks commercial substance. For measurement of the recognition, it have four methods to measure, which is cost model, revaluation model, depreciation, and impairment. So an entity shall choose either the cost model or the revaluation model in accounting policy and shall apply that policy to an entire class of PPE. Okay, first, for cost model, after recognition as an asset, item of PPE shall be carried as its cost less any accumulated depreciation and any accumulated impairment loss. Okay, second, revaluation model. After recognition as an asset, the item of PPE whose fair value can be measured reliably shall be carried at a revalued amount. Next, if the item of PPE is revalued, the entire class of PPE which the asset belongs shall be revalued. Okay, for depreciation, each part of the item of PPE with a cost that is significant in relation to the total cost of the item shall be depreciated separately. The depreciation charge for each period shall be recognized in profit or loss. And the last one, the depreciation method used shall reflect the pattern in which the assets' future economic benefits are expected to be consumed by the entity. For the derecognition, the carried amount of the item PPE shall be derecognized on disposal or when no future economic benefits are expected from its use or disposal. Second, the gain or loss arising from the derecognition of an item of PPE shall be included in profit or loss when the item is derecognized. However, an entity in the course of its ordinary activities routinely sells item of PPE that it has held for rental to others shall transfer such assets to inventories at their carrying amount. The financial statements shall disclose for each class of property, plant and equipment, which is the measurement base used for determining the gross carrying amount, the depreciation methods used, the useful lives or the depreciation rates used, and the gross carrying amount and the accumulated depreciation. For the application by company, we choose the company Box Park Malaysia Berhad and Bright Packaging Industry Berhad. For the basis for both company are same, which are stated at cost less any accumulated depreciation and any accumulated impairment loss. For the depreciation, Box Park Malaysia Berhad is calculated to write off the cost of the assets to their residual values on a straight line basis over their estimate useful life. For the Bright Packaging, no depreciation is provided on freehold land. Depreciation on other property, plant and equipment is calculated to write off the cost of the assets to its residual value on a straight line basis. And the last one, types of property, plant and equipment for Box Park Malaysia Berhad: long-term leasehold land, leasehold buildings, plant, machinery and equipment, motor vehicle, forklift, spare part and capital work in progress. While for the Bright Packaging is freehold land, buildings, plant and machineries, furniture, fittings and office equipment, and the last one is motor vehicle.